Hello and welcome to 5-Year Club video number 296. Tonight, an article from Yahoo: Big banks reveal challenges in consumer credit mortgages. The largest U.S. banks hinted at declining quality in credit card lending and tight competition in the mortgage space, showing that consumer credit is becoming a harder business to compete in. In third quarter earnings, J.P. Morgan Chase, Citigroup, Wells Fargo, and Bank of America all posted higher income on interest-bearing assets despite pressures from the Fed's rate hikes. The big banks relied on larger loan books to collect more revenue on higher interest loans. One easy place to juice loan growth: credit cards. J.P. Morgan Chase, which had an impressive 6% year-over-year increase in average core loans, reported that it had expanded its credit card sales volume by 12%. Challenges in loans. But the large banks are seeing challenging headwinds within lending as charge-off rates, a measure of defaulted balances, continue to rise. The Federal Reserve reported that credit cards in the second quarter of 2018 had a charge-off rate of 3.65%, 11 basis points more than the same quarter of 2017 and 62 basis points more than the same quarter of 2016. J.P. Morgan Chase CFO Marianne Lake said Friday that while her company's charge-offs remain extraordinarily low, she expects credit quality to continue its decline. Naturally, as the cycle matures, we will see charge-off rates rise, but we aren't seeing it yet, Lake said. All right, let's talk about this for a second, because I think a lot of people are going to miss what she means by this. When she's talking about cycles, she's talking about the debt cycle, right? She's talking about, the expansion of credit when the Federal Reserve dropped interest rates to the bottom to dig us out of 2008. And then as the economy improved, those interest rates stayed low. Credit became very available. The job situation got a lot better. Wages improved. And banks became more willing to loan money. And now, as we're reading this article, banks are very willing to lend money right now. They are in the loan business. And people, because unemployment is low, have the money to pay back these loans. But the better that things are going, right, they don't stay in a steady state. People tend to make stupider and stupider decisions and take on more and more stupid credit as things continue to go well. And as the stupid rises, the charge-off rates rise. And so that's what she's talking about. Eventually the charge-off rates reach a point where, the bank says this isn't worth it anymore. And they pull back lending. And, that's what we saw with, essentially with the housing crisis, right? Like they loaned a bunch of money to people stupidly. The people started defaulting on their mortgages. And, then these CDO assets that the banks had formed started going belly up. And the banks, ran out of liquid money. And so they stopped lending, and that froze up the economy. J.P. Morgan Chase, Wells Fargo, and Bank of America all reported increases in their net charge-off rates, while Citigroup said net credit losses on its credit cards increased by 5% year over year. Of course, every bank has a different approach to consumer credit. Citigroup, for example, pursues big-name retailers to develop co-branded cards. In the third quarter, revenues on Citi's branded credit cards were down 3% year over year, mostly due to the sale of its Hilton credit cards portfolio to American Express. On its third quarter call, Citi executives clarified that if the struggling retailer Sears does resort to full liquidation, the total impact would be about $300 million. Sears has a big credit card business, in case you didn't know. Wells Fargo and Bank of America have been more aggressive in growing their credit card loan books. In the third quarter, Wells Fargo expanded its credit card business by $1.1 billion as it continues to push its no-fee Propel card. Bank of America boosted its credit card loans by about $3.1 billion. Mortgages were not seeing any meaningful improvement. The big banks also reported languid activity in residential mortgage lending, a sign that the appetite for home purchases is weakening. Lake said she would expect the overall market to be down about 10% year over year. JP Morgan Chase's home lending business in the third quarter brought in 16% less revenue compared to a year ago, down to $1.3 billion. Lenders are likely facing difficult conditions in the space because of rising rates and a wealth of competition exacerbated by the increased presence of non-bank lenders like Rocket Mortgage. Wells Fargo CFO John Shrewsbury said a tight market has led to high pressure on pricing margins. The company saw its mortgage banking income decline 19% year over year to $846 million. We've not seen any meaningful improvement, Shrewsbury said of the pricing. At Citi, where total mortgage loans on book increased by 1% year over year, CFO John Gerspach was hopeful that lower U.S. mortgage revenues should abate going forward. Bank of America appeared to have the most mortgage activity and expanded its residential mortgages by 5% compared to last year. The company said 20% of its total consumer mortgage applications were done digitally, showing Bank of America's willingness to take on its non-bank competitors. The market for mortgages is steadily expanding. The Mortgage Bankers Association says that home mortgage purchase applications are higher in 2018 than they have been in the last 4 years. But the MBA still notes that low supply and increasing mortgage rates are holding consumers back from growing home purchases. Blah, blah, blah. Okay. End of the article. So, yeah, rising interest rates, fewer home sales, right? Lower home prices, but higher mortgage payments. And, we're seeing competitive credit card industry. And typically, what happens is when things get competitive, when things are going really well, bankers start chasing yield. And a big way that they do that is by going after people with poor credit ratings. So I would definitely expect to see more credit card products, more consumer credit products going forward that come up with a bullshit reason why it's a good idea to lend broke people money. Nothing new under the sun. 2018. And we still haven't learned lessons from 2008. Save some money. All right, well, that is it for 5-Year Club video number 296. Hope you enjoyed it. Have a fabulous evening.